Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Beg, Chief Economist, welcoming you to our 163rd episode. Today, it's just yours truly, sharing with you my impressions from my recent travels to Washington, D.C. The IMF-World Bank annual meetings, which was held there last week, was marked by, in my view, a distinct contrast. So let's explore that contrast a bit. On one hand, you had the published material, including that from the IMF's flagship publication, World Economic Outlook. That contained considerable amount of concern about the outlook. You shouldn't be surprised by the list of the concerns: increasingly difficult environment for trade, policy uncertainty emanating mostly out of the U.S., debt overhang in industrial economies, stretched valuation of many equity markets, AI bubble, and if it bursts. These risks clearly informed a rather subdued outlook for the medium term, even though the IMF revised up 2025 growth forecast marginally. Now, where's the contrast? The contrast came not from the published material, but from the communication, the oral communication of the management of the multilateral institutions. There was a sigh of relief that the worst fears around a collapse of trade and supply chain breakdown had not materialized. In fact, despite much foreboding about trade, export and import-related activities actually have been moving along pretty steadily. There was also some recognition given to the global systems of payments and finance, which seem to have withstood the uncertainty spike during April rather well. From the assortment of seminars and meetings with officials from governments, multilateral institutions, and think tanks, we found elements of resilience. We also saw some concern, so we did leave the meetings with a degree of discomfort that some risks may be being treated a bit too sanguinely by both policymakers and markets. But by and large, that point about some sigh of relief, I think is worth exploring. So let's think about the drivers of resilience. Governments and companies have gotten used to a perma-shock environment over the past decade. From Trump 1.0 to the pandemic, various armed conflicts, and AI disruption, the notion of steady state has more or less dissipated. Shocks are no longer shocking, just materialization of tail risks already considered in scenario planning exercises. Supply chains, narrow and concentrated half a decade ago, are now more elaborate, slightly less efficient, but also more resilient. Consumers dislike high cost of living, but they don't postpone consumption readily when faced with some price or quantity supply related uncertainty. Markets react to adverse developments with some risk aversion, but not panic. Sell-offs are not seen as begetting more sell-offs. Now, all this might sound a bit too sanguine, given the various stresses present in the global system of trade and commerce. But the fact is that the spike in tariffs and the plethora of trade restrictions imposed since April have tested but not defeated economies and markets. Capital flows, be it portfolio or direct investment related, have been dynamic, not stagnant. Investors have reaped strong returns along a range of asset classes. Financial conditions have eased. Currency and debt market gyrations have been modest. These developments give one room for optimism that even as more shocks invariably materialize in the near term, the risk of markets overshooting or economies stalling outright in response is pretty low. Case in point is the sharp ratcheting up of trade-related rhetoric between China and the US in recent weeks. The general view remains that despite unwelcome developments, chances remain good that the two sides will continue to talk and not inflict undue additional cost to doing business. U.S. economic outlook loomed above all during the annual meetings. On the institutional side, threats on the independence of the Federal Reserve were widely discussed. Given the repeated attacks on the current FOMC officials, there are genuine questions about where the Fed would go with decision-making next year with respect to setting short-term interest rates, regulating non-banks with stablecoin issuance, and managing massive public debt overhang. The final one, the massive public debt overhang, is really the job of the U.S. Treasury. But the line has blurred this year, with various Trump administration officials publicly musing about the amount of savings that would be incurred if the Fed cuts rates by, say, 250 basis points. A former Fed official noted to us that this is the ultimate illustration of fiscal dominance, that even the discussions around monetary policy are fully influenced by what's happening at the debt level. We heard from IMF officials that U.S. labor productivity growth has been impressive in the post-pandemic period. Adoption of technology, dynamic, well-remunerated job market, some improvement in infrastructure, and tightened immigration have helped, although it is not yet clear if this bump would last. AI-related disruption informs hiring sentiments, but consumers don't seem to be worried about jobs or income sufficiently to curtail consumption. The U.S. economy looks poised to keep growing at around 2%, helped by resilient consumption and robust investment. On the investment matter, there was an interesting observation made by some is that there may be an exaggerated sense of the impact of the AI-related spending. The fact is that investment has been getting a lot of support. Biden-era stimulus, the forthcoming tax relief under the Big Beautiful Bill, all of these are making fixed capital formation in the U.S. very well supported. And it's a general thing, not just related to AI. Resiliency of the U.S. economy notwithstanding, the questions related to fiscal sustainability lingered during the meetings. Industrial economy debt is strikingly high, but the U.S. numbers are truly worrisome. The tariff-related revenue spike so far this year is more than offset by tax cuts and spending rigidities, with no realistic policy agenda on the table to bring down the outstanding debt burden. Forcing the Fed to cut a lot would steepen the yield curve, which may in turn force the Fed and Treasury to engage in financial repression. With this backdrop, investors seem increasingly prone to hedging their exposure to U.S. debt and U.S. dollar. On prices, the U.S. seems likely to be characterized by around 3% inflation for the time being. Half a decade of above-target inflation is yet to dent Fed credibility, but this is not something that one should take for granted. Service sector inflation going forward is likely to be pushed up by labor shortage. Energy inflation may become an issue given the spiking electricity demand from AI data centers. Lack of fiscal adjustment and record-high stock prices will not help price expectations either. Put it all together, the Fed's capacity to engineer a major rate cut cycle seems highly problematic. We did not hear much about currency wars. While some U.S. government officials have asserted that a sharply weaker dollar is essential to restore competitiveness, this doesn't appear to be a dominant strain in the administration presently. It can come later, but not right now at least. If U.S. economic growth remains in the 2% range and the stock market does not undergo a sharp correction, the imminent currency market dynamic may well be one of U.S. dollar strength, upending the U.S. dollar weak narrative that has persisted for most of this year. We left Washington not with a relaxed outlook, but with some conviction that heightened and sustained geopolitical uncertainty did not derail the global economy. The foundations of trade and commerce are less fragile than feared. A worldwide stress test is underway. The results are decent. That really is for today. This podcast was produced by Ken Delbridge at Splice Studios. Violet Lee and Daisy Sharma provided additional assistance. Kopi Time is for information only and does not constitute any investment advice. All 163 episodes of the series are available on YouTube and on all major podcast platforms, including Apple and Spotify. For our research content and webinars, you can find them all by Googling DBS Research Library. Have a great day.